In this session 32 of a 36-session corporate finance class, I'd like to turn my attention to the biggest number in most valuations, the terminal value. It's a number that is powerful but can get people into trouble. And I will introduce some key constraints that will allow you to keep this number from running away from you. The last couple of sessions, we've laid the groundwork for doing valuations. We first talked about cash flows and discount rates, and then we talked about growth. But the biggest number, if you've ever done a discounted cash flow valuation, in that discounted cash flow valuation is that end number, the terminal value, the value that you attach to the business at the end of the high growth period. So what I'd like to do in this session is talk about the rules you should follow to keep that terminal value from running away from you. Because this is perhaps one of the most dangerous numbers in valuation, and if you don't take care, it can very quickly take over your valuation. So let's step back. Let's think about why we need a terminal value. Remember I said that the value of a publicly traded company is the present value of the expected cash flows on that company over its life. Well, here's the problem. The life of a publicly traded company is, in theory, forever. You cannot estimate cash flows forever. So what we do to get closure on a valuation is we estimate cash flows for a period of time, 3 years, 5 years, or 10 years. And at the end of the 10th year, rather than continue to estimate cash flows, we estimate what we think the business will be worth, or the equity in the business will be worth, and call it the terminal value. Of course, we've got to bring it back to today by discounting it, but that number is a stand-in for what we think the business is worth at the end of the period. Now, if you're doing an intrinsic valuation, you'll see terminal value estimated in one of three ways. One of these ways is definitely wrong, and I'll highlight that way. But here are the two legitimate ways for getting terminal value in a discounted cash flow valuation. The first is a liquidation valuation. If you have a business that you think has a finite life in the sense you think it can't keep going forever, you can stop your cash flows at that point, estimate what you think you will get if you sell off the assets, and take the present value of that liquidation value. For companies which may be mining companies or natural resource companies, or even for some private businesses, that's not a bad strategy. If you have a going concern where you feel unwilling to assume liquidation, then you can assume a stable growth model, where you assume the cash flows beyond that point in time grow at a constant rate forever. This is the more common approach for estimating terminal value, but basically you're assuming that beyond year 5 or 10, when you make this assumption, your cash flows continue at a constant rate forever. There's a third approach, which I think is inappropriate for an intrinsic valuation. In a lot of discounted cash flow valuations that I see, the terminal value is estimated by using a multiple. What am I talking about? If you look at the year 10 value, here's what they do. They take the EBITDA, or the revenues, the net income, or the operating income in year 10, and they apply a multiple. So if their EBITDA is 100 million, they'll slap an 8 times EBITDA on it and say the terminal value is 800 million. Now, what's my problem with that? If you think about where they get that multiple, it's almost always by looking at what publicly traded companies in that space trade at right now. In other words, it's a relative valuation. If you apply a multiple to get a terminal value, what you have is a relative valuation in drag. The drag component are the cash flows you've estimated for the next 10 years, and while I'm distracted by those cash flows, you're slipping in a multiple into your final number. If you're going to do an intrinsic valuation, keep it an intrinsic valuation. If you want to do a forward multiple to value the company, that's fine as well. But call it what it is. It is a relative valuation. So now let's talk about using that stable growth model because it's used so widely. Let's go back to the equation. The terminal value is the expected cash flow 1 year after. So to get the terminal value in year 10, it's the expected cash flow in year 11, divided by the difference between R minus G, right? The growth rate is your growth rate in perpetuity. Let's set the table for what that growth rate can be. First, because it's a growth rate you sustain forever, it cannot be greater than the growth rate of the economy in which you operate. You can define that economy as the US economy or the global economy or the Chinese economy, but it cannot be greater than the growth rate of the economy in which you operate. And the reason is simple. If you let your company grow at a rate faster than the growth rate of the economy, it will become the economy. And then you're going to have a problem. So first, there's a cap on that growth rate. It cannot exceed the growth rate of the economy. It can be lower. There's nothing that prevents your company from becoming smaller relative to the economy as it becomes a mature company. And there's an argument to be made that if you're looking at mature companies, that their growth rate should actually be lower than the growth rate of the economy. Otherwise, where would the growth companies go to get their growth? It can actually be zero. You can have a company where the stable growth rate is set at 0. And here's a surprising truth. You can set the stable growth rate at a negative number. In other words, you can tell me that after year 10, your cash flows will grow at minus 5% a year forever. You're saying, what does that mean? Basically, what I'm doing is I'm letting your company peak in year 5 or 10, your final year, and start to get smaller after that. That's actually not that unrealistic. In fact, you could argue that that's a much more realistic description of the world than assuming that every company will grow at 2% a year forever. Incidentally, a key thing to keep in mind is you tell me how you estimate your cash flows, and I'll tell you what the cap on the nominal growth rate or the cap on the growth rate should be. If you estimate your cash flows in real terms, you don't have inflation in them, then the cap on your growth rate is a real growth rate in the economy. If you estimate in nominal terms, then you got to tell me what currency you estimate it in. If you estimate in US dollars, your cap has to be a US dollar nominal growth rate. So if you switch to higher inflation currencies, you can get away using a higher growth rate, but your discount rate will also be higher. I think we talked about this in an earlier context, but let me repeat a rule that I find useful when I do valuation. One very simple proxy for the nominal growth rate in the economy in the long term is the risk-free rate. And here's why. Embedded in a risk-free rate is an expected inflation and an expected real interest rate. Embedded in a nominal growth rate is that same expected inflation and an expected real growth rate. Over the long term, and that's what we care about in steady state, the risk-free rate is actually a pretty good proxy for the nominal growth rate of the economy. So what I actually do when I do discounted cash flow valuations, I check my risk-free rate and I try to make sure that my growth rate does not exceed the risk-free rate. That takes care of different currencies too, because if I switch to a different currency with a higher inflation rate, my risk-free rate will be higher and my growth rate can be higher as well. So that's the first rule, is make sure you obey the cap. And it's a very, very specific rule. It's one of those rules that if you start to violate even by a little bit, your valuation can very quickly get out of control. Second, don't wait too long to put your company into stable growth. Here's a simple suggestion. Let's say you're valuing a young growth company, saying, how long can I allow growth to continue? Let me give you some choices, and you tell me which one you think is the most realistic choice. Remember, this company is right now a star company. It's got lots of growth. It's come in with a historical growth rate of 30, 40, or 50%. Here's your first choice. Less than 5 years. That sounds too conservative, right? Saying, how about 5 years? 10 years? More than 10 years? As you think about this, here's something I want to bring to your attention. If you look at young growth companies, especially in the US, and you look at how long growth lasts at many of these young growth companies, it's surprising how quickly growth starts to fade at these companies. For two reasons. One is scaling up is tough to do. Many young growth companies find it difficult to maintain growth as they get bigger. The second is competition kicks in. For whatever reason, it's better to be conservative when you think about young growth companies and not start using growth periods of 25 or 30 or 50 years. In fact, I'll give away a secret. When I do a valuation, the growth period I use is 0 years, 5, or 10. What am I talking about? If you ask me to value a company like ExxonMobil or Toyota, I'm going to use a 0 high growth period. The company's already mature companies. If you give me a company like Coca-Cola, which still has some growth but not that much, I'll use 5. For any other company, no matter how much growth potential I see, I'm going to stop at 10. That sounds conservative, because you can start naming companies which have grown for longer than 10 years, right? Microsoft, Google, Walmart, IBM. The very fact that you can name these companies should tell you that you're talking about the exception rather than the rule. You do not want to value a company to be an exceptional company. So I'm going to stop at 10 years. And when you think about what drives how long that growth period is, here's something to remember. When we talked about growth, we talked about it being computed as a product of the reinvestment rate and the return on capital. The value of growth actually comes from the fact that you earn a return on capital that is higher than the cost of capital. Put differently, if you grow and you earn a return on capital that's exactly equal to your cost of capital, your growth has no value. Flip that on its head. When you talk about your company being a high growth company that gets a lot of value from future growth, you're telling me that your company has strong and sustainable competitive advantages, right? Barriers to entry. The stronger and more sustainable the competitive advantages your company has, the longer it can grow. So there's no substitute for knowing what your company does, what its barriers to entry are, what the sector looks like, and what the competition looks like in valuing the company. We state a second proposition. Quality growth, the kind of growth where you earn returns on capital that are substantially higher than the cost of capital, is very rare. Lots of companies grow fast. Very few companies grow smart. So when you do valuation, focus on whether your company is growing smart or whether it's just growing fast. Now let's choose a growth period for the 4 companies that I'm going to value. For Disney, I'm going to use a 10-year growth period. That might sound extreme given how large the company is, but it's a company with tremendous competitive advantages, sustainable barriers to entry. I'm not going to give it a really high growth rate during that high growth period. It's only 6.8% to start the game. But I'm going to allow it to keep growing for longer than 5 years, in this case 10, because I think its competitive advantages are so strong. With Vale, I'm going to have no growth period at all. It's a natural resource company that's already the 3rd largest natural resource company in the world. There's not that much growth I can see coming to them, and if they go out and buy growth, my guess is they'll have to pay a fair price for that growth. So my growth period for Vale is 0 years. For Tata Motors, I'm going to allow a growth period of 5 years. Why? Because I think the Land Rover acquisition has given them a new lease of life. And the Indian automobile market is still growing fast. So those 2 factors built in will allow them to grow for at least a short period, in this case 5 years. In addition, the brand name and competitive advantages that came with the Land Rover acquisition will allow them to earn a return on capital above their cost of capital. With Baidu, all bets are off. This is a young company in a young market. I'm going to use my maximum growth period of 10 years to allow myself the opportunity to change the company as it goes through time. So obey the cap, don't wait too long. Let's think about applying this process to valuing Vale. I told you that I'm going to assume that Vale is already in stable growth. But here's a factor to keep in mind. Even though it might be a mature company, the earnings and cash flows for commodity companies go up and down. There are no stable, mature commodity companies because of the nature of commodity prices. So to deal with the volatility of prices over time, I did what I thought was a common sense thing. Rather than use the 2013 numbers to value Vale, I looked at the average numbers across time. And the average operating income over the last 5 years for Vale is $17.6 billion, and their average return on capital is close to 17.25%. Those are going to become my base numbers in my stable growth valuation. I already have an estimate of the beta based on the businesses they're in that I've computed. In this case, the beta that I have for the company, the levered beta, is 1.15. The risk-free rate I'm going to use is a US dollar risk-free rate because my cash flows are all in US dollars. And that's a choice I made because of convenience. It was easier to value Vale in dollars than in reais. 2.75% is my risk-free rate. And the equity risk premium I use of 7.38% is a weighted average equity risk premium of the different parts of the world that Vale operates in. So everything we've talked about in the context of corporate finance is somewhere here, right? If I bring in the cost of debt based on their actual rating, I come up with a cost of capital of 8.2% for Vale. I'm going to assume a stable growth rate of 2% a year forever. That's below my risk-free rate, and as a commodity company, I think that's a fairly conservative number. I use that 2% growth rate, the normalized income, which I got by averaging income over time, and the 17.25% return on capital. Now, here's how I estimated the reinvestment. I want to grow 2% a year in perpetuity, right? If I assume that Vale is going to be able to continue to earn 17.25% as a return on capital, that translates into a reinvestment rate of 11.59%. Basically, what that tells me is with that return on capital, all they have to do is set aside 11.59% of their after-tax operating income every year to get to their cash flows. So I have everything I need. I take that normalized operating income, I apply the 2% growth rate, I take out the reinvestment of 11.59%, I divide by the cost of capital of 8.2% minus the growth rate of 2%. The enterprise value that I come up with for Vale is $202.8 billion. You're saying, what does that mean? Given my estimates, I think Vale is worth about $203 billion, the operating assets alone. Now, I'm still interested in the value of equity. So here's what I do to get to the value of equity. I add back the cash that Vale has because the income from cash is not part of my operating income or cash flows. I subtract out the debt, and the value that I get for the equity is about $167.1 billion. I divide by the number of shares. The value per share that I get is about $32.44, well above the stock price at the time that I did this valuation of $13.57. You might say, what am I going to do about the big gap? Nothing. The whole point of doing valuation is to make your assessment of value, not to back into the market price. Based on my valuation, Vale looks like an incredibly cheap company. And I believe it is. In fact, I bought Vale after I did this valuation. But you should do your own assessment. Are there assumptions I've made in this valuation? Absolutely. So go in and change those assumptions. See how sensitive the value is to changes in those assumptions. But the key here is I'm valuing Vale as a mature company right now. And when I can do that, I don't need to forecast out the next 5 or 10 years. I don't need to do cash flows for the near future because all I need is a value today. Which brings me to the third piece of the terminal value puzzle. Don't forget that growth has to be earned. So if you give me a company with high growth, remember the company has to reinvest enough to sustain that growth. So basically, when you talk about a stable growth rate of 2%, the same rules apply. Companies have to reinvest to sustain that growth. In the previous example, the last page when I valued Vale, that's why I estimated the reinvestment rate using the growth rate and the return on capital. I would suggest you do the same thing. While you can get efficiency growth for short-term growth, you cannot count on efficiency growth forever. So if you're talking about a growth rate in perpetuity, which is what you're talking about when you're talking about a stable growth rate, it has to come from reinvestment. So what I'm arguing for is when you value a company, you have no choice but to estimate what kind of return on capital you think this company will earn in perpetuity. That's going to determine the reinvestment rate you're going to have in stable growth. Here's the thing to remember though. If you assume that the return on capital in stable growth is equal to your cost of capital, as some people do, then it doesn't matter what your stable growth rate is because growth doesn't matter. The reason I emphasize that is there are some books out there which argue that if you get your company to stable growth, if it's a mature company, its return on capital has to be equal to the cost of capital. The old McKinsey valuation book, which I have a lot of respect for, made this argument. But McKinsey's own studies indicate that assuming that for mature companies, the return on capital is going to converge on the cost of capital might be too strong an assumption to make. This is actually from a McKinsey study that looked at what happens to companies and you track them over very long time periods, decades. Over the decades, what you see is the growth rate starts to converge on the growth rate of the economy. That's an argument for pushing your company to stable growth. But what these studies also seem to indicate that excess returns persist, that companies can earn more than their cost of capital for decades. So given that fact, I think it does make sense to maintain some discretion. And if you're valuing a company, I want to give you that discretion of saying this is a special company. It's Coca-Cola. Brand name is a really long-term competitive advantage. So even when Coca-Cola becomes a mature company, I'm going to assume that the return on capital is higher than the cost of capital. The Vale valuation, the reason I left the return on capital at where it was, is if you're a natural resource company, you have a barrier to entry, right? Which is you own the reserves. So if iron ore prices go up, it's not like people can go out and find new reserves. So with natural resource companies, it doesn't surprise me that even mature companies can earn returns on capital above the cost of capital, and that return on capital is what you should use to come up with your stable growth. Okay. Finally, be internally consistent. What I mean by that is if you tell me your company is a high growth company today and that you expect it to become a mature company 10 years from now, which is what I'm arguing, for instance, with Baidu, I need to give Baidu the characteristics of a mature company. What are those characteristics? If my beta right now is a high beta, that's okay, right? Because I'm a high growth company. But if I'm a mature company, that beta should move towards 1. If I'm a high growth company, my debt ratio might be 0. Why? Because as a risky company, I can't afford to borrow money. But as a mature company, I should be able to borrow much more. As a high growth company, I might be able to earn 30, 40, 50% returns on capital. But as a mature company, I'd expect that return on capital to drift down towards the cost of capital. It doesn't have to go to the cost of capital. In other words, when you make your company a mature company, give it the characteristics of a mature company. So as a final piece, here's something to think about. I've seen a lot of discounted cash flow valuations where analysts get to their stable growth and they make a set of assumptions. And I'm going to list these assumptions out, and I'd like you to tell me what might be wrong with these assumptions. So here's a discounted cash flow valuation, and I'm the analyst pushing this valuation. In year 5 or year 10, I tell you that my company will become a mature company. So far, so good, right? I assume that my company will grow 2% a year forever. That's not bad because that's less than the growth rate of the economy. Then I tell you that because my company is a mature company, Its capex will offset depreciation. It does not have to make a net capex, and it does not need working capital. What have I said? Basically, I'm arguing that once I get to year 5 or 10, I'm not going to reinvest any money. My reinvestment rate is going to go to zero. If my reinvestment rate goes to zero, the only growth rate that's consistent with that reinvestment rate is a 0% growth rate. If you use a stable growth rate that's any number above zero, and you make the assumption that your reinvestment is zero, you have an internally inconsistent terminal value. So check your terminal value calculation to make sure that you are in fact reinvesting enough for stable growth. Now with Disney, as I said, I'm going to give them a 10-year high growth period. At the end of 10 years, I'm going to make them a stable growth company. So let's see how the rules play out here. First, I'm going to obey the cap. My risk-free rate in US dollars at the time of this valuation was 2.75%. I'm going to assume the stable growth rate for Disney is 2.5%, less than the risk-free rate. So I've obeyed the cap. Second, I'm going to assume the return on capital for Disney, which right now is 12.61%, will drop towards 10% in stable growth, still higher than my cost of capital of 7.29%. But I'm going to assume that the return on capital will stay higher because of Disney's sustainable competitive advantages. Why does that matter? With a 10% return on capital and a 2.5% growth rate, my reinvestment rate every year in perpetuity after year 10 will be 25% a year. Finally, the cost of capital, which is 7.81% now, will start to move down as my company becomes a mature company. And in particular, I'm going to move the beta towards 1, the debt ratio up towards 20%, and that pushes my cost of capital down to 7.29%. In year 11, Disney is truly a mature company with mature company characteristics, and that's critical in preserving consistency in valuation. In the next session, we'll come and bring all these numbers together and actually value Disney as a company, but you have the pieces in place to do a valuation. Thank you very much for listening.